Okay, very good. We are back again. All righty. So now we're up to problem number 6. And problem number 6 says that in 2020, GSE Inc. is to distribute a total of $190,000 as cash dividends to its common and preferred shareholders. Information regarding the shares is given as follows. So there's common stock. It has a $1 par value. They're authorized 1 million shares. Issued and outstanding is 800,000. And recall that we only pay dividends on outstanding shares. So if they had bought back some treasury shares, then the outstanding shares would have been less than the issue, but we only pay dividends on outstanding shares. Then there's also, in addition to the common stock, 7% preferred stock, $50 par value, authorized 20,000 shares, issued and outstanding are 12,000. So we have 800,000 common shares that would receive a dividend, and the 7% preferred stock with a $50 par value, they have 12,000 shares outstanding. So the first thing that we're going to do is assume that the preferred stock is non-cumulative. And what that means is that if there was no dividends that were paid, if the preferred shareholders did not receive dividends in a prior year, then they're not going to receive those dividends. It's just non-cumulative. If you didn't get it, you aren't going to get it. So what we want to know is, how are we going to distribute this 190,000 between the preferred and the common shareholders? Okay, let's see. I'm trying to open up this. Here we go. Okay. All right, so then the dividends for the preferred stock is going to be equal to, and I need to reference back to the notes because it says here that it's $50 par value, 7% shares, and there's 12,000 outstanding. So the preferred stock is $50 times 7%, because when it's a percentage of the par value, multiplied by 12,000 shares. And that gives us 50 times 7% times 12,000 shares, and that would be 42,000. Actually, I should say equal to 50 times 7% times 12,000. Okay, so that's 42,000. And then the common shareholders, they're just going to get the difference. And in this case here, the difference is going to be, we know it's $190,000 total. And of the $190,000, 42,000 went to the preferred shareholders. So the common shareholders will get 48,000. Okay, so all I'm doing is here figuring out, first of all, how much goes to the preferred shareholders, and then whatever is left from the total to be paid out is going to go to the common shareholders, and that was 148,000. All right. Just a minute. Let me get you back to to this document here. Okay. But if the preferred stock is cumulative, what that means is if they didn't pay dividends last year to the preferred shareholders, then before they can pay any dividends to the common shareholders in the current year, they have to pay any dividends in arrears. That is, dividends that were not paid in prior years. Okay, so note here that assume that the preferred stock is cumulative. We want to compute the amount of dividends that are going to be paid to the common and the preferred shareholders, assuming that no dividends have been paid to the preferred shareholders in the prior 2 years. And again, the total dividend that's being distributed is $190,000. So, now, okay. All right, so the dividends in arrears for the preferred shareholders. All right, so let me say here the preferred dividends in arrears, that's going to be equal to 2 years in arrears. All right, so that would be $50 times 7% times 12,000 shares times 2 years. All right, so that means that our preferred dividends preferred dividends in arrears is $50 times 7% times 12,000 shares times 2 years. So that's $84,000. Then the 2020 preferred dividend, and that's equal to $50 times 7% times 12,000. No more 2 years because this is only for 2020. This arrearages was for 2019 and 2018. So therefore, we have 50 times 7% times 12,000, and that is 42,000. So 126,000 has to be paid to the preferred shareholders before anything can go to the common shareholders when there is a cumulative preferred stock. All right, and in this case here, the dividends in arrears, or the dividends that had not been paid for the last 2 years. All right, so the 2020 common dividend is going to be the difference. We know, again, it was 190,000 total dividends, and 126,000 of that 190,000 goes to preferred shareholders. So the common shareholders then would get the difference, or $64,000. Okay. So again, what we're going to do is, first of all, compute what are the preferred dividends. And if there are dividends in arrears, that needs to be calculated as well. So we know how much has to be paid to the preferred shareholders, and then anything out of the total that's left will be paid to the common shareholders. Okay, so let's go back to our review sheet. Okay. Any questions or... All right, well, if there aren't, then I'm going to move on to the next problem. All right, so here we have information regarding NIC company inventory for the month of January. And the information that's given here, let me open this up as an Excel file. Okay, so here's the information that we have regarding the beginning inventory and the purchases during the month of January and the sales during the month of January. All right, so I've done the calculations for you for the purchases and the beginning inventory, but the calculations are just going to be the number of units times the cost per unit. And that would be for every single purchase that they had. So they had 150, they bought 750 more, then they bought 450, and then they bought 300. But these were all at different prices. So the total cost, and this here is the cost of goods available for sale. This would be $51,540. Okay. All right, so that's the cost of goods available for sale. How many units did they have available to sell? Well, what was in the beginning inventory plus what they purchased during the month. And that adds up to 1,650 units that were available for sale. Now they tell us, here's the information about the selling price. The sales. This is the number of units and how much they sold each unit for. So they sold 620 plus 700 units during the month. And so when we add those up, we see that they sold 1,320 units. So now the question is, okay, everything that they had available to sale cost $51,540. They had available to sell 1,650 units, and they actually sold 1,320 units. So how many units are in ending inventory? Well, it was available to sell 1,650. They sold 1,320. So therefore, the units that were in ending inventory is 330. All right, now what we need to figure out is what was the cost of these 1,320 units and what was the cost of the 330 units left in ending inventory. Okay, now I'm going to go over two methods: LIFO perpetual, weighted average periodic. Okay, so remember with LIFO perpetual, every time there is a sale, we are going to calculate the cost of goods sold. And with LIFO, the cost of goods sold is going to come from the most recent purchases prior to the sale. So in this case here, the cost of this 620 units is going to be equal to, now the last purchase was $750, so all of the 620 are going to come from this $750. So it's going to be 620 units times $31 per share. I mean, $31 per unit. Then we also have 700 units. Now, note here that 700, well, we can get 450 of them from the most recent purchase of units, but that's not going to be quite 700. So we know we have 450 units at $31.50. And then going back, we had 750 in the next earlier purchase, but 620 of those had been sold. So now there's 130 left. So there's 130 that are going to be at the $31 price. And finally, well, I'm going to come back to this in just a second here, but I have 700 units minus, 450 minus 750 minus 620. And so far, I need 120 more units, okay? So what I'm saying here is that 450 came at the $31.50 price. 130 came at the $31 price. And then 120 more we're going to have to cost them at the $30 price. So therefore, we have 120 times 30. Okay, so that's the math. Okay. Okay. Oh, you know what? I'm sorry. I thought I had shared the screen. Let me go over here. Sorry. Can you see it now? Okay, very good. So let me just kind of repeat what I've been saying. All right, so we computed the total cost of goods sold, which is just the sum of the costs here. We computed the units that were available to sell, and those were the units from the beginning inventory plus those had been purchased during the month. And then the units sold, this would be, well, they had 2 sales, 620 and 700, so that's a total of 1320. And then the units in the ending inventory, let me just put it this way. It will be what was available to sell minus what was sold. So this is what's left, 330 units. Okay, so what we're going to do next is we're using FIFO perpetual. And we want to know what was the cost of these 1,320 units using, I say FIFO, I meant to say LIFO, LIFO perpetual. All right, so let's see here. The first sale was 620 units, and that first sale would be costed at the most recent purchase prior to the sale, and that was these 750 units that cost $31 each. That would be the cost of that sale. But when it comes to the cost of the 700 units that were sold, we're going to take 700 from We'll take 450 of the 700 at the 31.50 price. That's what I have here. And then we have what's left from the 650. Well, let me go here. I'm going to say 750 minus 620. All right, sorry, 750 minus 620. And so that gives us 130 units that are left over at the $31 price. So we're going to, of the 700, now 130 are at $31. And then, all right. So this is how I came up with the 130, which is 750, but we've already used 620, sold 620 that we've costed at the $31 price. So what's left? What's left is going to be 700 units minus, we've costed 450 of them at $31.50. We costed 130 of them at the $31 price. So what's left? We still have to cost 120 units. So those 120 would come from the beginning inventory when the cost per unit was just $30. So this is the formula down here to figure out the cost of goods sold. So
it's 20.
The cost of goods sold is going to be equal to 620 units times $31 plus 450 units times $31.50 plus, you see I'm down here, I've got 130 at let me see here. That I think something is okay. 450. Okay. Let me try this again because I think I got something not quite right here. So it's going to be these 620 at $31 plus this 450 at $31.50 plus 130 that were also at the $31 price plus 120 that were at, not price, but cost at the beginning inventory cost. And so this gives us $41,025 of cost of goods sold. Now, the next question is, well, what's the cost of the ending inventory? We know that there's 330 units in ending inventory. 300 of those units were purchased after the last sale. And recall, all of that cost of 450, that's gone. The 750, which is 620 plus 130, that's all been used or sold. And then of this 150, 120 have been sold. So there are just 30 units left at the $30 price. So let's go ahead and compute the ending inventory. The ending inventory is 300 units at $32.05 plus 30 units, all right, at $30. So this is our calculation for the ending inventory. So that's going to be these 300 times 32.05 plus 30 units of the 150 that are at $30 a piece. So the cost of the ending inventory is $10,515. And so now what we want to do, or what I'm going to do now, is a check figure. And the check figure says that the sum of the cost of goods sold plus the cost of the goods in ending inventory will equal to the cost of goods available for sale. All right. And lo and behold, this is what has happened. So we have the cost of goods sold equal to, the cost of goods available for sale equals the sum of the cost of goods sold plus the cost of the ending inventory. Alrighty. Okay. Now, what's the gross profit? And we know that gross profit is equal to sales minus the cost of goods sold. So how much are the total sales? Well, do the calculations here. We have 620 units times $54 and 700 units at $60. So the total sales, total sales is going to be equal to the sum of these two. And that's $75,480. Okay. So now we can compute our gross profit. Gross profit is the sales, $75,480, minus the cost of goods sold, which we computed up here as $41,025. And that means that the gross profit is $34,455. All right, I'm going to ask you one more question. And you can answer this by sending me a chat. All right. What is the gross profit percent? Okay. What is the gross profit percent? So we know that the gross profit is $34,455. Now the question is, what's the gross profit percent? Well, as a reminder, the gross profit percent is equal to the gross profit divided by sales. So therefore, our gross profit percent is going to be 34,455 divided by 75,480, or 45.65, about 45.65%. Okay. Now, the next one that I'm going to do is weighted average periodic. Weighted average periodic, then we're going to figure out what's the weighted average cost per unit. And remember, carry to 5 decimal places. Okay. And the reason I say that is because then you won't have rounding issues when you're computing your cost of goods sold and the cost of the ending inventory. But the weighted average cost per unit is going to be equal to the cost of goods available for sale, and that was 51,540. Divided by the units available for sale, which was 1,650 units. So this formula here is going to tell us, on average, how much did one unit cost. All right, 51,540 divided by 1,650, and actually, yeah, so that's $31.23.636 per unit. So now, what's the cost of goods sold? The cost of goods sold is going to be equal to the units sold, which is 1,320 units, times the weighted average cost per unit. And that was 31.23636, which is the weighted average cost per unit. All right, so we're going to take 1,320 units that were sold multiplied by this, and our cost of goods sold now is 41,232. The cost of the ending inventory is going to be, how many units were left? 330 units in ending inventory times 31.23636. And that will give us 10,308. So what I want to do now is a check figure. And the check is going to be that the cost of goods sold plus the cost of ending inventory should be equal to 5140. So we're happy. All right, this is the total cost of the goods that were available for sale that we had computed up here. Okay, so now let's do the same computations in terms of gross profit and gross profit percent. So the gross profit using the weighted average periodic is sales minus the cost of goods sold. So the gross profit was 34,248, and the gross profit percent, gross profit divided by sales. All right, let me make that into a percent. All right, so in this case here, there is a a little difference, 45.65% versus 45.37%. But the point is, if you use FIFO, if you use LIFO perpetual, if you use LIFO periodic, if you use weighted average periodic or weighted average perpetual, you're going to come up with sometimes slightly, sometimes greatly different numbers that will be allocated to cost of goods sold, to ending inventory, which affects gross profit and the gross profit percent. And actually understanding this is really important in future, because when you're comparing company A with company B, one company uses FIFO, one company uses LIFO, then you'll learn how to convert the LIFO into FIFO numbers so that you can make meaningful comparisons between the companies. All right, my time is almost running out here, so I'm going to pause for a second to see if there are any questions. And just a moment, let me share my screen with you. Okay. Okay, well, actually, that's all that I had to go over for tonight. There's 3 more minutes left on this clock, so I will Oscar, I see that you're here, and Joy. Are there any questions on either what I've covered here or any other questions that you may have? I just want to note that I have not covered preparing a balance sheet or preparing an income statement, at least in this review session, but hold on, because I want to just pull up the review sheet, topic review sheet, kind of take a look at that. Okay, thank you very much. I've gotten feedback from both of you. Let me see. Is that no, this is the wrong one, excuse me. Let's see, bear with me a second. I'm trying to get the updated review sheet. Hold on a second. You know what? I've got less than a minute here, so I'm gonna just go ahead and close this out for now, and I will just plan to see you guys in class at some point in time, okay? All right, so have a good evening. Good luck studying on the test and the quiz. I hope this was helpful, and all the best. Okay, bye-bye.